Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. We're going to go over Twitter today and look at a bunch of commodity information and stock market information. I'll give you my financial opinion on it. And it's just information out there of what's going on, what's being shared amongst individuals on Twitter. If you want to follow me on Twitter, it's at finding_finance. That's how you can follow me if you want to follow what I'm reading and watching. So Goldman Sachs warns of an imminent oil supply shortage. This is what I've been talking about for this supply shortage that is coming up. I'm not the only one who sees it, but again, it is out in the future, and we're waiting for these conditions to come. They do address in this article a lot of the things that I look for and that maybe people aren't accounting for. So it says crude oil could swing into a deficit that will make next year a difficult one as spare production capacity dwindles and underinvestment threatens future supply. So we've got analyst Jeffrey Curry. He said that industry is not spending enough to secure future production and that spare capacity globally is declining. And that's what I'm talking about. Mine is from a different source. These guys mirror each other. Mine's from the Goring and Rosenzweig group. I've also heard Curry say this quite a bit, that spare capacity is going to decline and that we are going to demand will exceed pumping capacity of the world. Do I know the exact moment that that's going to happen? No, I don't. But it's going to happen over most likely the next few years. It says this could tip the oil market into a serious supply problem next year, but the price for a barrel of Brent could top $100 before then. According to Curry, rising demand from China and sanctions on Russian oil will contribute to the deficit, which he expects to manifest in the second quarter of this year. In response, producers will tap their spare capacity, leaving it lower than it was before. Eventually, this will lead to a serious imbalance between supply and demand. Right now, we're still balanced to a surplus because China has still yet to fully rebound. And that's what I'm talking about. That's what I mean when I talk about things take time. It's not immediate. It says, are we going to run out of spare production capacity? Potentially by 2024, you start to have a serious problem. And when I read this, it's not about trying to get the short-term timing potentially perfect. It's not about that. It's about understanding what's coming ahead of us. And it's not stating that this has to be perfect. What I invest in is the trend. The trend of oil is getting tighter. And potentially there could be some problems out in late 2023, early 2024. And that's where there could be serious problems. And it's like that for a bunch of different commodities coming over the next few years. So when I look at this and I read this information about, are we going to run out of spare capacity? We've got potentially a 2024, you start to have a serious problem. All of these so-called sanctions, embargoes, lack of investments, they will convolute into one thing and one thing only, a lack of energy supplies of all kinds when they are needed, the most needed. Brent crude has been trading between 75 and 80 a barrel for most of the year, along with other believes it has higher to go. So when I read through this, guys, and I look at this and I read this, I think, okay, there's going to be some sort of potential supply problem out in the future. I don't worry about the short-term volatility. I look out there and I say, how should I position to play this? Do I play it with the exploration production companies? Do I play it with the energy service companies? Who's going to make the money from a so-called shortage in oil? And, you know, there are companies who are oil rich. There's companies that are oil and natural gas production. And where should I be buying this? In what jurisdiction? All of those different things. So I look at this, I see this opportunity that's ahead of us. And now what I'm thinking is, how do I position for it? And what sort of allocation should I put to basically benefit from this? How much should I risk for this opportunity? And that's really what a lot of investors have to think about. They have to think about how much am I going to invest in this type of thesis, so to speak. So moving on back. The smartest people I talk to have no idea how Bitcoin works or what problems it solves. I wanted to retweet that because, you know, I've got a lot of people, we know what Bitcoin necessarily is. We know what the idea is behind it. We don't know what problem it necessarily solves. We know what it's trying to solve. We don't know if it actually solves it. That's where the debate is. So when people say, oh, it's this, it's that, and then they just jump on board. Well, it's like, well, what problem does it solve? Which is, oh, they're printing currency. This has a fixed amount of some fictitious cryptocurrency made up by humans. And then we're supposed to trade this stuff around on a network that isn't quite ready. Now, I understand people will say that the network will get ready and that people will adopt Bitcoin, and Bitcoin is the end of all things. I would argue that Bitcoin may not get adopted. It might not. Who knows? The value is in the things that people want. So from an investment standpoint, there's still a lot of value in investing in the things that everybody wants in the world. They all want food. They all want what money can buy. They don't really care about the money itself to some degree. As long as they get what they want, that has value. Will Bitcoin win in the end? I don't know, but I just like the quote because it makes some sense. There are a lot of smart people that don't know how Bitcoin works, but I can tell you the people that think they know how Bitcoin works probably doesn't know how Bitcoin works either. I'll just say that. You've got people who thinks they know how it works, and you have people who say, I don't know how it works. It says, might take a bit of an optimist to see the Livermore accumulation pattern still intact, but turns out I'm exactly that. To me, this is screaming a buy. And this here is Uranium Energy Corporation. UEC is the ticker symbol. 1, 2, 3, 4, 5, 6. And then you go into that kind of double hump, and then you get the launch. We're right there at that launching point for Uranium Energy Corporation. There's a lot of other uranium companies that also exhibit the Livermore accumulation cylinder. There are some that have even larger 3 waves that are bigger fractals, meaning that the potential move could be bigger on the backside. If you're part of the website, we do go over that type of fractal. We measure some of those things, and I give my opinions around which ones could outperform in the sector given the size of the fractals and previous outperformance. Looking at this, we've got another nail in the energy cliff coffin. The energy cliff is the declining energy from fossil fuels. It says Indian Prime Minister Narendra Modi, however you say it, on Monday projected that the country's gas demand would rise 500% due to the rapid pace of development. Pray tell, where are we going to get all of this extra natural gas? So a lot of these areas are in the middle of their S-curves, increasing their fossil fuel consumption, whether it be oil, natural gas, coal, whatever it is. But people are starting to figure out, it's like, where are we going to get all this? It's like, this is a big increase for a lot of people and the wealth of a lot of people. And I'm going to show you another kind of graph on wealth and energy consumption and how it's related. And right now, these guys are trying to lift themselves out of poverty, and it's going to require copious amounts of energy. So the way that I view this is that there's a large opportunity in energy investments flat out. That can also include a lot of the metals, because metals are going to be used to transport electricity, to build infrastructure, et cetera, et cetera. We've got a Moly shortage. This is molybdenum. It says China's stainless steel producers squeezed as the cost of molybdenum concentrate is at its highest since 2005, after more than doubling since August of last year. So the cost of key stainless steel ingredient is surging, molybdenum. And look at that thing. We've got the double hump there. 1 hump, 2 hump, and then the move higher. I see that a lot for some reason. So this is kind of like that first hump. Then you get this double like lead-in hump, and then you get the surge. This double hump is also in a lot of natural gas and oil companies that I've seen. That same little double hump. It's also in some of the energy service companies that I follow. So that is another interesting thing to see, is that human psychology is being transferred across like everything. So look at this. So this is no energy consumption, no long-term sustainable economic growth. And that's what I'm talking about, the middle of the S curve. So this is electricity consumption per capita. So that's per person. It says no such thing as a low energy rich country does not exist. As your wealth increases, or as your electricity consumption per capita increases, so does your GDP per capita. So these are the richest ones on the right. These are the poorest. It is by no means that the poorest use the least amount of electricity consumption. Electricity consumption, or energy consumption for that matter, is basically just countries converting commodities and electricity or energy into products, which basically means the richer you are, the more you convert things into products or use energy. So you either produce more or you consume it. So what I mean by you consume to produce, or you consume it because you will elect to spend more of your income on energy. So that is a cool chart, I thought. It says the irony is that U.S. Treasury bonds are still considered the safest liquid asset to own, but are they? Now, this is kind of interesting here. It says the CEO of Bank of America says that they are preparing for a possible United States debt default. This is the second largest bank in the United States. This circus is coming to town. I don't know. I mean, I have nothing verifying that they said that. I just kind of retweeted this because I saw that. If that is the case, you know, I've talked about potential problems in our debt in relationship to GDP, and that something like this could happen out in the future. I don't know the exact timing of it, but it looks like some other people are catching on to it as well. That's why precious metals might be a good spot to be looking. It will, I think, protect you in any sort of problem with a currency. Bonds and currencies are tied together. If there's a problem in the bond market, they usually try saving it and basically destroy the currency. Yes, they can both fail as well. So what they're saying is we could see some sort of problem with debt. That's all. We've got silver stair-stepped up from the classic bottoming and formed the pink pattern below the blue line. That's this guy right here. It's a channel, or a little bit of a squeezing of a channel. It tried to break out above the 2.5-year blue bull flag, but was low on energy late in an up move. So it had a false breakout. A false breakout can create strong move in the opposite direction. So here's your false breakout to the upside. It just didn't have the energy to break out, and it came back and sold off. That is silver there. Maybe we have to kind of relax a little bit, regain our strength and energy, and make another run higher out in the future. This here does tie into this here, and this here in terms of bonds and all that stuff. There's reasons that yields are starting to move up dramatically. It's either, and the dollar, it's either to protect the currency, or they've lost control of the bond market and yields are going to spike higher because there's no buyers for it and a lot of sellers. So that they're all tied together here. It is interesting to see someone say this at the same time that we are seeing some weakness in the precious metals markets. So here's URA. This is my boy Scott from Uranium. Says, I was going to do a video on this, but I couldn't find the time. So I have the time to do the video. This is URA. You can see the downtrend lines breaking. We got our first little pullback here. Very similar to what has happened before in Apple, where you get a breakout and then you get the pullback, and now we could get a big launch. We call this the retest or backtest move after a breakout. So the first thing you do is you kind of break out, then you get a return move to this breakout, some sort of return move. It doesn't have to go all the way back. Sometimes it does. Sometimes it exceeds it a little bit. But it is a first return move. And then we wait for the buyers to come in and launch it higher. At least that's what we want to see. Here's URNM. This is the ETF for uranium. It says I've hidden all my lines and clutter except one golden trend line. So here's the golden trend line. 1 hit, 2 hit, 3 hit. We popped out above it, and now we're doing that retest move, and we're back towards that gold trend line. We want to see buying pressure here. We want to see a reversal candlestick, or maybe it dips below with a nice little wick on the bottom. We call that a hammer candlestick. But some sort of reversal candlestick is what we're looking for if uranium were to break down a little bit and then head on up. If we're going higher, we got to see buying pressure here. We don't want to see a ton of selling pressure just rip right through it like it's nothing. Here's the network effect, has been all the rage. Looking forward, I see it as being the embedded energy effect. The higher the embedded energy, the higher the replacement cost in a world short energy. We've talked about this before, Trader Ferg and I, and I brought up the idea of embedded energy. And what embedded energy means is how much energy does it take to replace whatever that thing is. And if you have a world of very expensive energy, he calls it short energy. It's the same thing. It's synonymous. Expensive energy is short energy. How much higher is the cost going to be to replace something? So the more cost of energy it takes for a product, the harder it's going to be to replace that thing. So when you look at this, and we're looking around the world, we're looking at some of these things that are just massive in terms of energy, embedded energy into that item. Think of it as like gigantic ships. You know how much energy it takes to build a dry bulk ship? It takes a lot of energy. It takes a lot of energy to build these gigantic offshore drill ships and drill rigs and all of these different, we'll call large scale machineries. All of the gigantic Caterpillar machines, those big dump trucks that do a lot of mining. There's a lot of money and embedded energy in those. And I think when we look at a world with short energy, that could be a gigantic barrier to entry for a new company. So the companies that have existed or have existing infrastructure in place and have existing, we'll call it those gigantic machines, that has a lot of embedded energy, and it provides a moat around it when energy is expensive. So all of these companies that have acquired these assets with cheap energy of a paradigm looking backwards, and with the paradigm looking forwards of expensive energy, it's a gigantic moat for that company, or a high barrier to entry for new companies to try to come in and take market share. So there's a lot of, we'll call it margin expansion that could happen in a period of time when we shift from a cheap energy environment to a more expensive energy environment because of the embedded energy effect. That's what's really going on there. Here's Eric Nuttall. It says, lots of short-term noise with the late Q4 Russian pre-buying. Warm weather, big U.S. builds, refinery turnaround driven, WTI contango, and weak time spreads. Interestingly, global oil inventories continue to fall, and its deficit to normal continues to widen. We remain bullish in the meantime. There's that inventory deficit in relationship to the 4-year average continuing to decline. These are global onshore oil inventories. You can see from about week 24, they're all basically left to right in a downward fashion. The green line does creep up here a little bit. That is 2019. But 2023, you can see it's way down here in terms of global oil inventories onshore. Way down there compared to all the other years. The other years have been going and declining. 2021 is the blue one. We had a massive decline there. 2022 is this low one down here that was declining. And then we started back over here. So we continue to decline over time. That's going to put upward price pressure on it eventually for oil. It says, many seem to think that the British pound is history. This massive 20-year bullish red falling wedge says otherwise. It says the fourth most traded currency will outperform the USD hugely going forward in the big picture view. So this is the British pound versus the United States dollar. It's a ratio. And we've got the 1 hump, 2 hump, 3 hump, and we're probably going to break this to the upside of a falling wedge. What this means is that the British pound most likely will outperform the USD, the dollar. So we could see dollar weakness going forward with at least comparing these two currencies on a relative basis. Here's one, too. It says the housing market update. It says mortgage rates below 6% for the first time since September. Home sales up 3% since December. Average home price up 1.1% since last year. Mortgage demand is up 30% in 2023. Median rent up 5% year over year. And the housing market wants a soft landing. And again, I don't know where interest rates are going to necessarily go here. And I do think this is highly tied to interest rates because we saw mortgage rates dip for a little bit. Then we saw the home sales kick up. Then we saw all of this, mortgage demand kick up. I do think that interest rates are the thing that's holding it back. And interest rates very well could go higher and hold it back further. That is a possibility. A bear's worst nightmare. This is a break of the upward move, which could be a 33% move to the upside. If this happens, I think uranium and a lot of these other stocks are going to do some crazy things. But this here is the S&P 500, yes. And we're breaking to the upside of a megaphone type pattern. Here is the cumulative point and figure breakouts or breakdowns. So this is the totals for the week. We've got plus 1,196 double top stock breakouts, minus 201 double bottom stock breakdowns. So the majority of these is 995 net stock breakouts minus the stock breakdowns. That's at plus 995. We're looking at the market breadth here. Further expansion above the 200-day moving average this week, and the 20-day moving average also crossed the 200-day. You can see the black line of this breakout. This is the cumulative point and figure breakouts that we're moving to the upside for the breadth of this move. And generally, if it's a wide move like this, we're going to see an up move in the markets. So that's why I'm sharing this. And that's where we're going to end it. We're going to end it there. And that's what we've got for today, guys. And again, I look out a few years, 4 or 5 years. If we have an underinvestment in oil, what do you think is going to come next? If we need oil and we're short oil and oil prices go way up, there's probably going to be a very large expansion in the investment of oil when the price goes to a certain level. Who do you think is going to benefit from that? And if oil becomes harder and harder to get out of the ground, who do you think is going to benefit from that? If we have embedded energy problems and a lot of the infrastructure in place takes a lot of energy to build, and we come into an energy shortage where costs rapidly increase, who do you think is going to benefit from that? Those are the answers that I'm trying to basically solve, and what that's going to lead you down is the road to who is probably going to make the most amount of money in this next bull market. And I'm trying to set up a portfolio that's well balanced to capture the big moves. Well balanced between exploration production, well balanced between energy service, between uranium, between all of these different areas where I'm going to capture what I think are potential solutions to the problems that we have today. That's who's going to make the money. That's where the money's going to flow. It's not just investment money either. It's money that the consumers, they're going to have to spend more of their money towards energy than other things. And it's going to be inflationary, in my opinion, because energy touches everything. It's the number one commodity. So I'm trying to figure out how do you play this in a way where you have high probability, you get the wide moat around something. Embedded energy, I think, is a smart way to play it, which is a barrier to entry, which means tighter, bigger squeezes. I'm also trying to figure out what, in an energy expensive world, what would people do and what would they transfer to and how would products change over time? Obviously, I'm in the aerospace industry. We want to reduce weight wherever possible. I would think that would migrate into the automotive world. More aluminum use is what comes to mind for me. We use a lot of aluminum in aerospace, and I would assume aluminum is going to make a very big way into automotive. So I think aluminum could be a material that you could think of. And obviously, there's other materials as well that might do very well that are very lightweight. Graphite, graphene, etc., whatever it is. But I'm just also thinking about all of those things and how the world's going to change into the future 10, 20 years from now, and where potential investments could be at with wide moats. All right, guys, that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel if you haven't already, and we'll catch you next time. This is Finding Value.